Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. As I zoom in here, you'll see that I left my lines on the chart from last week's report, where we marked this horizontal line as resistance. And remember, this here was last Friday, right at that top, and I said we would most likely pull back to the 20-period moving average, which is that blue line. And as I zoom in there, you can see that the market on Friday closed almost exactly at my target price. Now, if you look down below, you'll see that the oscillators are hinging lower. The stochastics right here, the blue line is the percent K, the red line is the percent D. So if those lines cross on Tuesday, then most likely we're going to continue lower because that'll generate a sell signal. Now down below here, that's a CCI. If we get across below that black line, which is the zero line, that's also known as the momentum line. So we'll most likely continue lower if that line is breached for about 2 to 4 days on average. So my forecast for Tuesday through Friday on the Russell is going to be lower. Remember, it's a shortened trading week because of the 4th of July holiday. We have a support level down here. I don't think we're going to get all the way down to that level, but I think in the 4 days we'll at least pull back and then start closing below that 20-period moving average. So that's IWM. If we look at the diamonds, that's ticker symbol DIA. You'll see that my forecast lines was that we would go up, test this resistance, and start to pull back. We absolutely moved right up to resistance. In fact, on Friday, you'll see here as I zoom in, that high matches right up with my pivot point. So I think we're going to start heading lower. Notice the stochastics is at a super high level, around 100 level right there. And that is as high as you're going to get. Now, the other indication here of a possible pullback is in the divergence between the K and the D. You see that? If you look back at the past, I'll duplicate this and move it on over. You'll see that whenever the stochastics starts moving that far above the D line, we generally get pullbacks. And that is an indication that gives us a leading edge, more or less, that the market is overbought. So I'm going to keep that target in place. In fact, what I'm going to do here is I'm just going to duplicate that, move it on over just like that, so it's the exact same target. And again, the end of that line being 342.79. I think that's where we're going to wind up next Friday. So we'll have to keep an eye on that. In addition to the stochastics being overbought, CCI is also overbought. But look down here. Look at the drop in volume over the last 3 trading days and how that volume is dropping. That's an indication that the buyers are losing that momentum, and you have to really keep an eye on that, because when the buyers lose momentum, that is when the sellers start to move in. All right, so that's DIA. If we take a look at the VIX, you'll see that we hit my forecast on the downside pivot. We're bouncing off of this support level right here. See, last week I said we would move lower, test the support, and start to bounce. We're right at that general support level right here. I'm keeping that in place. Remember last week I said that was a long-term price target, and this horizontal line, that's my price target that I'm leaving until we hit it. That's up there around 22.25, almost 22.5. And on Friday, look there, we closed with a perfect textbook hammer pattern. That's when you have a small body candle that has a shadow that's 1.5 to 2 times the length of the body. So we have that, and so I believe we're going to move up towards the end of next week, especially. Again, my target all the way up here. This is going to be the slope that I'm looking for on the next rally for the VIX. And that brings us to the SPY, which is the ETF for the S&P 500. You can see that we did move up. I said we would most likely set a new high. We did that on Tuesday right here. Thursday, we broke through the weekly high and closed on another high. Now, because the volume is slightly higher on this one, again, I'm keeping that target in place longer term to pull back to the moving average, but I think early in the week the SPY could move up just a tad because we see that volume increasing on the close on Friday. So I'm going to move it like that and then pull back. Eventually, I think the S&P is going to pull back with the rest of the markets as the VIX starts to turn around. Now, if we take a look at the Qs, this is the only one that missed on the forecast. But notice what's happening down below. We set another high on the Qs. But interestingly enough, as I zoom in here, you'll see that the stochastics is hinging lower, even though we set another high. Now, on Friday, we gapped up. It was a pretty strong trading day dominated by the bulls, but that gap is most likely going to fill and fill pretty soon. So we have a wide divergence from this moving average right now. I'm going to talk a little bit about that when I switch to the monthly chart, but we have that wide divergence from the moving average, and I think the gap will start to draw it back towards that moving average later in the week. Notice also on that higher high for the Qs, we've been maintaining lower highs on the CCI. That's a negative divergence. So again, my price target for the Qs is going to be 349.25. So if you have anything in the tech sector, make sure you're trailing your stops up and protecting those profits. Now, if I look at the monthly chart now, I've made it very clear that long term I am considering myself to be the grizzly bear of the bear market that's about to hit us. And the reason I say that is because if you look at a 20-year chart of the Qs, this is the widest divergence we've had from that moving average in decades. Now, because I have my chart set at a 20 period moving average, because I'm on a monthly period right now, that's a 20-month moving average. And that divergence tells us that it's an extremely overbought market, and you have to really be careful. Now, I found something last Monday that I think you'll find very interesting, in that this is a graph that shows the deviation of the S&P 500 index as it compares to the 24-month moving average. Now, remember, I just said I tracked the 20-month moving average, so we're pretty close in this. And if you look very closely here, you'll see that back in 1999, the divergence right here, I'm going to draw a little arrow for you, the divergence above the moving average was about 18%. Okay, and that was right before the crash of 2000. That was the tech bubble, and that's why I'm really relating this to the Qs right now, because it's pretty much the tech sector as we see it. Now, currently, we are over 25, close to 30% deviation over that moving average. And this is a super high risk market that we're in. Now, if we move forward into 2007 right here, you could see the deviation was about 17 to 18% there as well, reaching levels much, much higher right now in this current overextended market. And all the signs for me technically are pointing lower. And you might say, well, if you think the markets are going lower and everyone else might start to think we're overbought, then why do we keep going higher? Well, obviously, the Fed is pumping money into the system, but there's a great supply of money right now, and that is where the inflationary threat is coming. So eventually this bubble is going to break. I'm not going to give you an exact date. I'm just telling you that on May 21st, I called a top, and I also said I'm not calling a high, I'm calling a top, because topping patterns take time. And this is one of the greatest tops that I've seen in a long time with regard to the overextension of the market and the overbought condition, not just of the S&P, but the markets as a whole. So be very, very careful. Stay tuned to our reports each and every week. Please like and share. Thank you so much for doing that, by the way. Our numbers are increasing. A number of subscribers are building. It's just really incredible, and I have all of you to thank for that. So please enjoy this 4th of July weekend. For those of you who are celebrating it here in the U.S., be safe, and I will talk to you next week. So long.